Good afternoon, everyone. I wanted to welcome you to our third webinar on the CARES Act, this time related to the guidance for use of funds and also on the forgiveness of the loan amount. Before we get started, as always, a quick disclaimer. This is really intended for discussion purposes. We're not going to be able to cover every detail or really outline or predict every single question. Wehowever, we do strongly encourage you to reach out after the presentation or at any time. Send us your questions and we'll get back to you as soon as possible. My name is Jon Paul Davis. I'm a partner with HHM. I'll be leading this webinar rather. I've got with me in my office a couple colleagues who may chime in from time to time. This is fairly complex and nuanced, so I appreciate all the help. What we'll cover today, we're going to go over a quick update on the loan. Just as a refresher, I know many of you have already received your loans. Some of you are pending funding and have already gone through the application process, so I'll be brief in the update. We're going to look at the various details of forgiveness. There are several rules, some new based on more recent guidance, some from the Act itself. We'll outline what forgiveness looks like, how to obtain it, how to manage your loan funds to try and maximize the amount of forgiveness available, if that's the intent. And then also various limitations that are in the Act, as well as in the additional guidance released by the SBA and the Treasury Department that may limit forgiveness. So on the update for the loan, it was clarified that all loans would have a 6-month deferment. The Act originally said available would be up to 12. Now it's been clarified. It's 6 months of payment deferrals of both principal and interest. Every loan will be a 2-year loan, meaning once the initial 6 months have ended, any portion of the loan that has not been forgiven will initiate payments over the remaining 18 months of the loan. So I want to be clear, it's not a 2-year loan after the deferral period. It's 2 years in total where payments will happen after the first 6 months. The Act limited interest to up to 4%. We know from the Treasury and the SBA that the interest rate is set at 1%. So let's talk about the forgiveness. The interim final rule was issued on April 2nd. This helped provide additional guidance related to what's called the PPP loan program. Everyone knows or is well aware of the PPP loan, the Paycheck Protection Loan. This additional guidance included the statement that the SBA will issue additional guidance on forgiveness. And as of today, we haven't received it yet. And I'm sure everyone is eager to, as we are, to see what those final rules will be. So I want to make clear that what we will review today are the rules as we know them based on the information that's available. However, as we've seen with certain provisions in the Act, namely the term length, the interest rate, the SBA guidance and the Treasury Department FAQs have superseded certain rules. So we do expect that once we receive this additional guidance, it could change or supersede the language that's in the Act. If you've already received your loan, you may, your question might be, well, what do I rely on? And in the Treasury FAQs that were issued on April 10th, stated that applicants, borrowers, and lenders rely on the rules, laws, and guidance that's available at the time of the relevant application. We expect the same. So you may need to rely simply on the guidance that is in the Act now, that has been detailed in the additional guidance from the SBA and the Treasury. And then as you're actively managing the use of these funds, you may need to pivot at any given time. And I think that's why it's important to have an ongoing conversation with your advisors as you're going through the 8-week period once you receive your loan funds. So just to recap, if you want to do some nighttime reading, which can be long, especially since the act itself is over 800 pages, I just want to make sure everyone's aware. You can go to the Treasury Department website and click towards the COVID-19 section that will include these items for download or review. But essentially what we're looking for and we're referring to in this webinar is the CARES Act, which was effective March 27th, the interim final rule, which was issued April 2nd. There are additional interim final rule addendums related to affiliations or related to LLC members. Those are available on that site as well. And then also the Treasury Department FAQs, which has the last update was on April 13th to include additional questions. So as we're going through, that's primarily where we are pulling our information. So let's talk about what forgiveness could be. The potential is for 100% loan forgiveness based on the funds spent during the 8 weeks after the loan's made. So once you receive the actual loan funds, it's not when you apply, it's not when you're approved, it's when you actually receive the loan funds that will start your 8-week period. And the funds to achieve the forgiveness need to be based on these what's called covered expenses. So that's slightly different than what is an allowed expense, and we'll look at that a little bit later. That mainly relates to interest expense on debt that is not a mortgage debt. And we'll review these covered expenses in just a minute. As an example, if you received your funds today, the end of that 8-week period would be June 10th. There's some overlap of dates. There's a reference in the act to June 30th, and we'll look at that too. But when you're considering the use of your funds, that ending date will be variable depending on when you receive the funds. So I just want to make sure that's clear. Payroll costs. So as a covered expense, you can make a payment for payroll costs. This is similar, if you'll remember on your application, you had gross wages, salaries, commissions, cash compensation, and there will be a cap at an annualized rate of 100,000. So I want to make sure that when we say annualized, that's a per pay period annualization. As an example, if you have an employee that normally may not, you have maybe a base compensation plus a variable or a commission-based amount, generally doesn't have compensation of excess of 100,000 during any given year. However, they have a great month, and in the first month of your covered period, that 8 weeks, they have compensation, they're paid monthly, of $10,000. That would be capped at the maximum on a monthly basis of $8,333, because the cap is based on a per pay period annualization. So I just want to make sure that that is detailed. On top of that, payroll costs, this is above the cap. You can include group healthcare benefits, the sick, parental, vacation, and medical leave, retirement benefits, and local and state taxes on compensation. And if you have any questions, a good refresher is how you computed the loan amount itself. Specifically excluded would be what we just talked about, that compensation of in excess of 100,000 on an annualized per pay period basis to any one specific employee. Compensation to employees outside of the United States that would not qualify. Qualified sick leave, which is the new uh, leave pay that's available under the Family First Coronavirus Response Act. Since those amounts are credits on your payroll expense filings, those are excluded as covered expenses, essentially avoiding a potential double dip in the use of funds or provision of credits. Let's talk about the allowed expenses. So mortgage interest, and to be clear, not the principal amount. Utilities, uh, and for the utilities and the rent and the interest on other debt, as well as the mortgage interest, each one of these items need to be on obligations that were in place and executed before February 15th, 2020. Now, specifically to the utilities, this could be a very large bucket of expenses. Could include telephone costs, internet. Uh, there's been debate as to whether that includes waste disposal. There's the term transportation that could be included. I think it's important to really consider what could be a utility, discuss with your advisor whether it's allowed, and really start putting a pencil to how much can be included in each one of these buckets. Under rent, we've seen a lot of questions related to a triple net lease agreement and whether the obligation under such a lease would create essentially um, transmute uh, insurance or real estate taxes into rent. In our opinion, is that the rent portion itself is what's allowed. The insurance and the real estate taxes, since they're separately listed, they're simply the responsibility of the lessee and so are not included as rent. But that's an interesting question. And if you've got it, make sure you talk to your advisor about it. Let's talk about the proportion of expenses. So in my mind, this is the new 75-25 rule, which was not included in the original act. And we're going to go over this rule first because it is the one that may require a borrower to really focus on the use of the funds during the initial 8 weeks, more so than an astute reader of the act would have done so just based on what we'll call the 60-30 rule, or the 630 rule rather, that we'll get into a little bit later. Essentially, the SBA and the Treasury Department clarified that at least 75% of the loan to be forgiven must be spent on payroll items. Only 25% can be spent on non-payroll items and still obtain forgiveness. Now, I want to be clear, once you receive your loan, if you spend it on mainly rent, mainly utilities, and some on payroll, and not enough to hit this 75-25, it really simply affects the amount of forgiveness. So the consequence or the penalty is you're left with a true loan. So let's look at two examples. Your total loan is $200,000. In the first one, your rent is $30,000, utilities $2,500, and payroll $167,500. You can see you've got at least 75% and even more in payroll. And so this would qualify, or could qualify, and we'll talk about certain other factors to consider, but just on the initial 75-25 rule of where you spend your dollars, it qualifies entirely. On the second scenario, you see that 50% of the loan amount is spent on rent, and then a much smaller amount on payroll, $97,500. So under this one, it would affect the forgiveness of this loan. It doesn't necessarily mean that the entire amount is unforgivable. It simply reduces the amount of forgiveness available. One question we've seen come up fairly often is, can a bonus be allowed under these rules? And what we would recommend is to really focus on that capital, that annualized cap of $100,000. An employer can certainly have uh, a bonus to their employees. Uh, you know, to get to the 75% spend of your loan, if you only have commission-based employees, you may need to consider more of a base compensation, at least for the 8-week period that you have the loans and you need to spend the funds. And again, let me stress that this management is under the assumption that your intent is to obtain 100% forgiveness. If that's less of your goal, you may not be as concerned about certain items here, such as obtaining the 75-25 rule, or not exceeding the cap for any given period. But essentially, as long as your payroll per pay period is under that annualized $100,000 rate, then the full amount of that pay is allowed as a forgivable amount. Under example number 2, you can see that at 9,500 monthly comp, assuming that this is an employer that has monthly payroll, the figures are somewhat different if you have weekly payroll, if you have bi-monthly or bi-weekly. And we can answer some of those questions outside, but for simplicity, we're really just using monthly payroll in our figures, just to keep numbers a little bit more simple. So essentially, you can see under scenario number 2 that you have annualized pay in excess of 100,000. The pay is allowed. I want to be clear about that. You can pay that amount. It's just that when you go to apply for forgiveness, what will count for that employee for that pay run will be 8,333, not the 9,500 that was actually paid to the employee. And I think that's been an item of discussion as well, is if you have a payment to an employee and it exceeds the 100,000 annualized rate, is 100% of that pay excluded? And we disagree. Our opinion is that it is limited to the maximum of 100,000, and the excess is simply ignored for the forgiveness calculation. For your full-time equivalents, the Act and the guidance don't necessarily speak to the full-time equivalent, and that's because you need to refer back to the actual definition by the SBA under the 7A program, for which the PPP loan is a new temporary loan program under the 7A guidance. So for a full-time equivalent, this will come up quite a bit more in our presentation. A full-time equivalent employee is an employee that works greater than 30 hours a week. So if you have an employee that works 70 hours every week, that's still one full-time equivalent. So when you're calculating your FTE, what you need to do is count 1 for each full-time employee, and then for all your hourly employees, sum all of their hours and divide by 30 to calculate the equivalence. Then simply take the number of full-time employees plus the equivalent of your hourly employees, and that will be your FTE. You need to calculate this based on a few different time periods, and we'll go over that in just a minute. Let's look at the factors for forgiveness. The 75-25 rule. And we've gone through, and to help with sort of remembering these and to give somewhat of clarity, we've tried to name them for simplicity. So the 75-25 rules, this new guidance that was from the interim final rule, and we've gone over that, and it outlines specifically how funds are to be used and the expectation of the Treasury and the SBA. There's the 630 rule, and generally this one is in the act. It follows what I call the 8-week rule, but I'm going to go over it first because it appeared to be more of a safe harbor uh, based on the language in the act. And so it's important to keep your mind on this 630 rule, which is based on June 30th, um, and understand the language and the guidance in the act itself as you then consider the 75-25 rule, which is really your spend during the 8 weeks. And the 8-week rule considers a reduction in your FTE headcount during the 8 week that you have the loan and you're spending your money, and the reduction in compensation, which is employee specific on a per employee basis. So we'll go over each of these. 75-25, we've already covered. So let's jump into the June 30 rule. The June 30 rule considers if you've had a reduction in headcount, and that is a reduction in the number or the average of FTE employees, or a reduction in salary on an employee-specific basis. And it considers the reduction is if you have a reduction in either headcount or in compensation on a per employee basis between February 15th, 2020 and April 26, 2020. The 630 rule states if you eliminate that reduction in headcount, you eliminate that reduction in salary, then you don't need to consider potential reductions based on your FTE or your salaries. And so that's why, in my mind, this essentially was a safe harbor where you could, under the language in the act, feasibly receive a loan, keep the funds, and as long as you eliminated a reduction in headcount and a reduction in salary, you could obtain 100% forgiveness. And so that's why the 75-25% rule is so important, in that this safe harbor may not be as advantageous as we once thought, because you must still spend during the 8 weeks, which will not necessarily line up to June 30th, 75% of your loan amount on compensation or on payroll. So keep in the back of your mind, this 630 rule is you can eliminate the reduction in headcount, reduction in salary on a per employee basis by June 30th. It can help mitigate some of the penalties that reduce your forgiveness. However, if you're considering this rule, keep in mind that 75% of your payroll costs, of your loan funds, need to be spent on payroll cost. And so you might think, okay, I'll keep the funds and then spend them near the end of the 8-week period, or at the last week, and then just make sure that I eliminate my reduction in headcount and my reduction in salary. And my caveat to you, or warning rather, is pay attention to the $100,000 per pay period annualization cap. To get to the 100,000, to get to the 75% spend, you might need to then have large bonuses, which would not be eligible for forgiveness if they are in excess of the annualized cap. So just keep that in mind as you're considering this.
So Jon Paul, if you plan on doing a kind of a pay true up with your employees, you may have to spread that over several weeks. Is that correct?
That's right. So it really takes what could be a heavy look at the end of the period and forces you to really consider the spend of compensation throughout the 8-week period. That's right.
Also, to your point, the June 30th was the prevalent item that we all used in advising our clients before the last set of documents came out. And so for most of us, it's really the 8-week period. And you would, in some cases, it may line up June 30th in the 8-week period, but for most people, it will not. So there's going to be a 2 to 3 week gap between when you have to spend the money and maybe that safe harbor that you mentioned, correct?
That's right. That's right. And under this example, if you were funded today, the 6/30 date would be several weeks after the end of the 8-week period.
John Paul, another question that I know that all of us have been fielding on these same lines is it measured on cash basis versus accrual? You talked about rent, you talked about payroll. In the 8-week period, it makes it sound mainly about cash being forked out and not really being what's accrued, correct?
That's right. It's based on your cash spend. So if you, one question we were discussing this morning is if you haven't yet paid your rent amount, you may want to decide to wait until you receive your loan funds. If it's a question of a day or two.
Which sounds silly, which sounds silly, but you might want to defer your rent until you get the loan, even though you would like to think the loan documents will allow you to accrue for it and just get a deduction for it. But if you get your rent payment or your loan payment in the middle of the month and your rent is due on the first of the month, instead of having 2 months rent payments, you could only have one rent payment included, right?
That's right.
As far as cash outlay. So you may want to think about when you're actually going to pay the bills. When are you going to pay your health insurance? When are you going to pay your rent payments? Ideally, we're going to get to look at some of this on the accrual basis, but just in case we don't and it's all about cash, we need to group those up and pay them during the 8-week period.
That's right. That's right. Going over general guidelines for your full-time equivalent, that is the head count on June 30th, going back to that February 15 level. And I want to be specific that it's really FTE. It's not, you have to have the same employees on June 30th that you had on February 15th. You have to have the same full-time equivalent number. I would be careful and caution on hiring family members. While there isn't specific guidance that precludes related entities or related parties as employees, there could be. So before you run out and hire your entire household, it could be something to discuss with your advisor.
On that note, Jon Paul, I think in working with many clients, we know that you're going to have to add certain employees back, and some of them will find other jobs or won't be back or will stay on unemployment because unemployment is where it is. So we just don't want you to rely. We want you to think ahead and make sure that you're going to hire people to come on board, and it may be at the end of the 8-week period, or maybe 6 weeks in, and not the June 30th day. Is that correct?
That's right. That's right. And to be clear, this June 30 rule is in the act. However, it could be severely curtailed or superseded based on the yet to be released SBA guidance. So in my mind, really to focus on the forgiveness and to manage it is to look at, one, the 75-25 rule, where you need to spend at least 75% of the loan funds on payroll. And then two, managing that throughout the 8 weeks that you have the loan. Just some thoughts. Staffing and your hours can be somewhat difficult, simply based on how do you get to the full-time equivalent number for this. Especially, we've got questions from clients that can't open or cannot be open or under an order not to open. How do you get staffing back to where it should be to obtain the forgiveness if you're closed? And possible solutions could be focus on telecommuting, hiring employees to work from home, assigning hours to certain staff. And as unpalatable as it could be, is also considering paying your employees, even if they're not able to come to your place of business and be productive.
Yeah, to that point, in certain areas with our clients, they're not able to open. So it came to it. They would obviously love to not have to put these people on payroll because some of them cannot offer any type of benefit to the company. So, but it is we have not found an answer in talking to their attorneys that look, this is why the law, the money is available. I think you have to bring them like on staff. You find things that they can do remotely, and then with the hope that obviously the stay-at-home orders will change. But if you don't do that, you're not going to get the debt forgiveness, and you're going to owe the money back. There has not been a carve out. Maybe there'll be a carve out with the next set of documents, but currently there is no carve out for that.
That's right. Let's look at the forgiveness limitations. So if you're not looking to the 630, let's call it that safe harbor rule, then how do you manage the loan proceeds during what we'll call the 8-week rule? So consider part 1, the limitation on forgiveness based on headcount. And this is where you have the option to use different FTE comparison points. So you're going to look at your monthly average FTE during the 8-week period, and you're going to divide it by either the average FTE count from February 15th, 2019 through June 30th, 2019, or your monthly average between January 1, 2020 and February 29th, 2020. So our recommendation is you calculate that FTE count of the bottom 2 options there, February 15th of last year through June 30th of last year, compared to the first 2 months of this year, and choose the lower figure, which would be most beneficial to you. So then you're going to compare that. One question that we've seen often is, well, the 8-week period is not the same as the comparison point of February 15th through June 30th, nor was it the same as the comparison point to get the loan. If you're required to spend the funds during 8 weeks that you borrowed based on 2.5 months, that is the reasoning for the 75%. 8 weeks is 75% of 2.5 months. So the intent being that you really do need to rely on either increasing payroll or your other covered expenses to get to the 100% spend. And one quick question, I've seen a question come up that, are we saying that we have to spend 75% on payroll or none will be forgiven? And no, we're not. The 75% is the rule you need to get 100% forgiveness. If you spend less than 75% on payroll, it would be a reduction of your forgiveness amount. So let's look at the headcount limitation. Just high level example. You have a loan of $1 million. Your headcount on an FTE basis, February 15th, is 150. Headcount June 30th is 75. Essentially, what that means is you haven't hit your 630 rule, so you need to consider the 8-week rule. So you're going to look at your full-time equivalent count between January 1 through February 29th of 2020, and that's 150. You compared that to the other one, which was February 15th through June 30th of 2019, and this was the more advantageous figure. Then you look at, you compare it to your FTE count during the 8-week period, which was 50. And as you can see, the loan amount and the forgiveness amount is dramatically reduced. And so what you want to consider here is you have a percentage reduction related to the FTE count. So it is important to consider on an ongoing basis how many full-time equivalent employees you have. You can, during the 8-week period, if you have part-time employees that want to work full-time, they can work full-time and count as an employee. But I will mention, if your part-time employee goes from 20 hours to 60 hours, that will only count as one employee. It will not count as two.
Jon Paul, do you see people hiring toward the end of this period to meet this rule? Not that
I do, but you also need to remember that it's based on your average monthly during the entire 8-week period. And also, if you ramp up your employment at the very end, it's going to be difficult with the salary cap to get to the 75%. So our recommendation is you've really got to put a pencil to it, work with your advisor, look at your payroll spend, your overall spend, chart it out and manage it throughout the entire 8-week process. It's possible to ramp up and get there, but it might take a little bit more math to make sure you're on the right path.
So basic simple math says by week 2 or week 3 into the loan process, you will start adding back employees probably.
You'll start adding back employees, or you'll start to know what amount will not be forgivable.
That's right.
You'll start to get an idea of what you might need to repay or what you might need to retain so that you can make your repayment. Part 2 of the limitation on forgiveness relates to salary. And this loan forgiveness would be, so you look at the loan forgiveness that was on our previous slide related to headcount. And then you consider compensation per employee. And this is on a per employee basis if you have a reduction of compensation in excess of 25%. So if you had an employee that at any time on a per pay period basis had annualized compensation in excess of 100,000 at any time during 2019, that employee is not considered in this part 2 salary limitation. So as a way of example, if you have employee A who in all of 2019, total wages were $94,000. However, in February of 19, their payroll, and again, we're looking at just a monthly payroll, so one payment a month, was $10,000, then that annualized rate would have been $120,000. And so that employee is excluded from the calculation of the reduction of the loan amount for forgiveness. And I've got an example that follows. If you look here, employee 1, you compare 2019 annual comp, and remember this is based on a per pay period basis. So while this is high level, it might take sharpening your pencil a little bit. But employee 1 annual comp was under 100,000 on an annualized basis. So you're going to look at the compensation year to date, compare it to the previous full quarter. Okay. So you're going to look at their compensation during the 8 weeks, and you're going to compare it to the year to date compensation of the previous full quarter. And since the previous full quarter will most likely be the first 3 months of 2020 for all applicants and borrowers. So note that these are year-to-date figures. So employee number 1, through the first 3 months of March, had $10,000 of compensation. Then let's say loan funds were received on April 7th. So from April 7th through June 2nd, the compensation over that covered period is $6,000. The way you get there is to do a year-to-date comparison between the start and the end. So 17,000 minus 11,000 is 6,000. So if you compare the 6,000 under the 8-week covered period to the first 3 months, which is 10,000, you have a 40% reduction So the amount of the reduction in excess of 25% is $1,500. So the amount of your loan forgiveness is then reduced dollar for dollar by the per employee basis reduction of compensation. So if you look at employee number 2, their annual compensation was over $100,000, even though their percentage reduction is 60% in this example, they're not considered. So it's not considered. That one is fairly complex. I definitely recommend getting with your advisor on this. It's going to take tracking your compensation on a per employee basis. If you terminate an employee or an employee leaves during the covered period or before the covered period and you hire for the same position someone else, in our opinion, that it is only for the employees that continue with you. And so if they were with you during the first quarter, they're with you in the covered period, it's what did the employer do to that specific employee's compensation during that time. So if you have a terminated employee and another employee was hired to fulfill that same job, then it would not be considered. That employee compensation would not be considered. Couple items just to recap. Consult with your advisor early and often. We believe documentation will be key. Recommendations from several banks are to use a new and separate account to receive these funds and then to track your disbursements. The AICPA goes a step further and mentions create 2 new accounts, one with 75% of your loan proceeds, one with 25% of your loan proceeds. And then go ahead and make sure that you document the use. Really, you can use any account, an existing one. However, I do believe it is beneficial to have at least a separate account simply for documentation purposes. The verification on the forgiveness piece may be much more intensive than the actual loan application. And so if you can make it easier on yourself to show that forgiveness or trace the receipt of the dollars and to the spend of the dollars themselves, since there may be additional verification needed by the SBA and your local bank to submit for forgiveness of this loan, then that separate account could be extremely useful. We're going to go ahead and wrap up. I want to encourage you to send your questions. We will respond ASAP. If you join late or you have a colleague or a friend that was not able to listen in today, we will post and release this copy of this video online, as well as our slide deck and some frequently asked questions. I want to thank everyone for joining and for listening in, and hope everyone is staying safe given the current circumstances.